Hello everyone. So this is the last part of chapter 1 and we're going to be going over financial statements. So financial statements is considered to be the final product in accounting. Of course now we're just going to get a brief idea or quick idea about what are the financial statements and how they are related to each other. But in future chapters we're going to go in more details about the financial statements. So after transactions have been recorded and summarized, reports are prepared for users. So these reports, we call them the financial statements. The primary financial statements of a corporation are the income statement, statement of stockholders' equity, balance sheet, and statement of cash flows. And typically this is the flow that we, or the order that we use. We start with the income statement and the statement of stockholders, then we prepare the balance sheet, and then finally the statement of cash flows. So the income statement, which is typically the statement we start with, it's a summary of the revenues and expenses for a specific period of time. Usually it's a month or a year. Income statement only focuses on revenues and expenses. It does not cover anything related to assets, liabilities, or equity. Only revenues and expenses. Then we have the statement of stockholders' equity. It's a summary of the changes in stockholders' equity that have occurred during a specific period of time. Could be a month also or a year. So in the statement of stockholders' equity, we want to see what happened to equity. What is the amount of change and what are the reasons for the change in equity. Then another important financial statement is the balance sheet. This balance sheet is based on the accounting equation. So we expect to see assets, liabilities, and equity. So it's a list of assets, liabilities, and stockholders' equity as of a specific date. Usually at the close of the last day of a month or a year. And there's a big difference between the balance sheet and all other statements. The balance sheet is like a snapshot. It covers a specific day. But the income statement, statement of stockholders' equity, and even the statement of cash flows, they cover a period, starting from one day to another day. And I always like to present this like a balance sheet is like a snapshot. You take a still photo or still picture. For the income statement, statement of all stockholders' equity, or the statement of cash flows, it's like a video where you see what happened during this period. It's not just one specific moment. So the statement of cash flow is a summary of the cash receipts and cash payments for a specific period of time, such as a month or a year. Statement of cash flow is also one of the important statements, but it only focuses on cash, how much cash is in and how much cash is out. Some might think, what is this? How is this different from the income statement? And I tell you, there's a big difference between what is considered to be revenue and cash receipts. Not all revenues are considered to be received in cash, and not all cash received are revenues. And that's why we have to differentiate between the statement of cash flows and the income statement. And we'll have a separate chapter for the statement of cash flows, which is the last chapter in our coverage. So let's start with the income statement and see here an example of how it looks. So you see here, we start always by writing the name of the business. So Net Solutions is the name of the business. We have the title of the statement, which is income statement. And as you see, it's for the month ended November 30, 2003, or year 3. So this means that it covers a month that ends on November 30th. So technically it's from November 1st to November 30th. The income statement focuses only on revenues and expenses, and the difference between revenues and expenses, if it's a positive value, we call it net income. If it's negative, we call it net loss. In our case here, we have a net income. And you can see in this column, we just compare the two main values. We have the fees earned, which is a revenue, and we have the total of expenses, which is between parentheses, which means it's a subtraction. So that's how accountants like to put a negative sign. Sometimes they put the parentheses. And the difference between these two is the net income. Since fees earned is more than the expenses, we see that we have a positive number here. So that's why we call it net income. The composition of the total expenses are all these expenses, starting with wages expense, rent expense, supplies expense, utilities expense, and miscellaneous expense. So when we add them up, we move them to the right column, and that's the total here. But we put them between parentheses because we're going to subtract them from the fees earned. So that's the first statement that we usually start with. And I always think about an income statement as straightforward because it only focuses on revenues earned and expenses incurred, and that's it. And you get the difference, net income, and you need that to prepare the next statement, which is the statement of stockholders' equity. So the statement of stockholders' equity, again, it's for the month ended November 30th, year 3, and it has a few columns here. We have the common stock and retained earnings, and that's the total. The common stock represents the contributions of the owners or the shareholders. Retained earnings is the net value of net income minus all the dividends distributed. So this is what we call it, the retained earnings, or the what are the earnings that are retained in the business. So I think the name or the title explains it all. So, and then we have a total column. And we start with the beginning balance. Of course, this was a business that just started. So on November 1st, they didn't have anything. They didn't have any common stock or retained earnings. So both of these were zeros. And then they had issued common stock. And remember, Chris Clark, the owner, brought this amount, $25,000. So that was common stock, which created a total of equity of $25,000. Then we had net income, which was $30,000 or $3,050. And where did we get this from? We brought it from the income statement. So one thing I want you to remember, we can't prepare the statement of stockholders' equity unless we already prepared the income statement, because one of the values that we'll need is the net income. So the net income, we brought it forward from the income statement. So it's $3,050 here, and then the total is $3,050. The next line is dividends, which is the amount of distributions to the shareholders. And remember, that would reduce retained earnings. So we put it under retained earnings column for 2000 with a parentheses because it's a subtraction. So the amount of change in the balance of November 30th, it went from 0, now it's 25,000, and for retained earnings, it's 1,050. We add them together, and now the ending balance for the statement of stockholders' equity is $26,050. This amount is very critical because we are going to use it in the next statement, which is the balance sheet. So this is how the balance sheet looks like. Net Solutions, the name of the company. We have the name of, or the title of the statement. And then you see here, we don't say for the month ended. We just say November 30th, 2003. So, or 2023. So this is a specific day. So that's a limitation on the balance sheet. We cannot really say how much assets we have during a period. It's just how much cash we have it on that specific date, and that's why it's a snapshot. We see what we have at that point. So we have cash, we have supplies, we have land, and that will give us a total assets of $26,450. And then with liabilities, we have accounts payable of $400. And then the stockholders' equity, you have the common stock, and we have the retained earnings, which we brought from the statement of stockholders' equity. And their total is $26,050. We add the $26,050 to the liabilities, and we get the total liabilities and stockholders' equity of $26,450. These two values should match, the total assets and the total stockholders' equity and liabilities. Remember, the balance sheet is based on the accounting equation, and that's why total assets should always equal total liabilities and stockholders' equity. Once we have this ready, the next statement to be prepared is the statement of cash flows. And the statement of cash flows just shows the change in cash. So we need to see or try to reconcile this value here, the cash. We want to make sure that this amount is correct, the $5,900. So this is also a statement where we say for the month ended November 30th, 2003 or year 3. So the statement of cash flows is divided into 3 parts. We have cash flows from operating activities, cash flows from investing activities, and then cash flows from financing activities. At this point, I don't want you to know more than that these are the 3 components of the statement of cash flows. In a future chapter, we're going to go in details about the statement of cash flows and understand how we can structure it. So for each section, whether it's operating, investing, or financing, there are 2 parts. We have the cash received and the cash paid. So cash received from customers or cash that would increase the amount of cash that we have. Cash paid reduce the cash balance. So that's why the cash received is positive, the cash paid is negative, where we see the parentheses here. We get it total, and that would be the net cash from operating activities. And when I say total, because I'm adding a positive value to a negative value, and it's 2,900. Then the same thing for investing activities. That's cash paid for acquisition of land. It was 20,000 in a negative. And then cash flow from used or used for financing activities. We have the cash received from issuing common stock and the cash dividends. And we have here positive and negative values, and the net value is $23,000. We add these three values and we get the amount of net increase in cash. Then we have the cash balance at the very beginning of the year. We add to it the amount of change. We get the cash balance at the end of the month. I meant like the beginning of November 1st, and that would be end of November 30th. Keep in mind, this is a business that just started, so their beginning balance was 0. Now it's 5,900 at the end of November. And that reconciles with what we have here in the balance sheet. It's the same value. So that's the typical sequence that we follow in order to prepare the financial statements. We start with the income statement, statement of changes in stockholders' equity, or what we call it, statement of stockholders' equity. And then we have the balance sheet, and then the statement of cash flows. So one more time, the income statement. It reports the revenues and expenses for a period of time based on the revenue and expense recognition principle. And we'll talk about that again, and we'll stress on it more to understand what we mean by the revenue and expense recognition. These principles match revenues and their related expenses so that they are reported in the same period. The excess of the revenue over the expenses is called net income, or sometimes we call it net profit. Some businesses, they simply call it earnings. And I think you heard me saying all these three over like my presentation here, because they all have the same meaning, whether it's net income, net profit, or earnings. If the expenses exceed the revenue, then we call it net loss. The excess of the expense over the revenue, we call it net loss. For the statement of stockholders' equity, this is a statement that reports the changes in stockholders' equity for a period of time. It is prepared after the income statement because the net income or the net loss for the period is reported in the retained earnings column. It's reported before the balance sheet because the amount of the common stock and retained earnings at the end of the period is reported on the balance sheet. So please remember that, because the sequence is very important. I need the net income from the income statement to prepare the statement of stockholders' equity. And then I need the retained earnings value and the common stock value to show that on the balance sheet. Then we have the balance sheet, and this is a financial statement that focuses mainly on the accounting equation, where we have the assets, liabilities, and stockholders' equity. And sometimes it's presented in a vertical format, sometimes in a horizontal format, but what we have here, it's in a vertical format. This form of balance sheet is commonly used and is called the report form, which is the vertical format. Then we have the statement of cash flows. And in the statement of cash flows, as we discussed before, businesses engage in three types of activities: operating activities, investing activities, and financing activities. And at this point, this is all what I want you to remember, these three kind of activities. The components of each one of these we'll discuss in a future chapter. So operating activities reports a summary of cash receipts and cash payments from operations. So anything related to the buying and selling of the business. The net cash flow from operating activities normally differs from the amount of net income for the period. Investing activities, that's everything related to investing in long-term assets. So reports the cash transactions for the acquisition and sale of relatively permanent assets. We like to call it long-term assets. Then we have the financial activities, and these reports the cash transactions related to cash investments by stockholders, borrowings, and dividends. So anything that's related to long-term liabilities or equity would be part of the financing activities. So one more time, I want you to remember the financial statements interrelationships. We have the income statement and the statement of stockholders' equity. The link is the net income or net loss. For statement of stockholders' equity and the balance sheet, we use the common stock, retained earnings, and the total stockholders' equity at the end of the period. These are reported on the statement of stockholders' equity and the balance sheet. And then the relationship between the balance sheet and the statement of cash flows is cash. So the cash reported on the balance sheet is also reported at the end of the period, cash on the statement of cash flows. We can look at the balance sheet as a connecting link. Okay, so you see here we have the assets, we have the liabilities, and we have the stockholders' equity. So these assets, only cash, the cash part, was used in the statement of cash flows. So you see here the balance represents the cash that we had the discussion for when we went over each one of the transactions. And then we have common stock and retained earnings. These are part of the statement of stockholders' equity. See these two values here and their total. And then for the income statement, we used the net income is the same value as the net income reported on the statement of stockholders' equity. So that's why we cannot prepare the statement of stockholders' equity until we prepare the income statement. The last part of this chapter is to do some analysis for decision making, and I think this part is very useful. In every chapter we're going to go over some kind of analyses and where we use ratios to make some kind of interpretations from the numbers we have. So basic financial statements are useful to bankers, creditors, stockholders, and others in analyzing and interpreting the financial performance and condition of a company. And you know, maybe for those of you who are not going to be accountants, but they're going to be in business, this would be a very useful tool for you because you can go back to these ratios and use them to make decisions, business decisions, smart business decisions. So various tools and techniques that are often used to analyze and interpret a company's financial performance and conditions are described and illustrated in the coming slide. So the relationship between liabilities and stockholders' equity can be expressed as a ratio of liabilities to stockholders' equity. So we have a ratio called liabilities to stockholders' equity. So we basically calculate the total liabilities, total stockholders' equity, and we divide them by each other. If you think about it, total liabilities and stockholders' equity, these are accounts that we're going to find in the balance sheet, because remember, these are accounting equation accounts. So we have to go back to the balance sheet, which focuses on the assets, liabilities, and equity to be able to calculate this ratio. So let's see this example. The following data, which are in millions, from a recent balance sheet for this company called Twitter, which I'm sure all of us heard before, and Alphabet, which is the new name for Google, or the official business name for Google. So we are comparing Twitter to Alphabet. For year one, the total liabilities were $2 billion, and for Alphabet is $44 billion, or close to $45 billion. Total stockholders' equity is $5 billion, and for Alphabet is $152 billion. You can see that Alphabet is much larger compared to Twitter. But with all consideration, also Twitter is considered to be a very large company. In year two, you can see that for Twitter, it's also growing. Like their total liabilities is now 3.3, which increased almost $1 billion more, and their stockholders' equity increased by almost 1.8 or 1.75 billion. Now it's 6.8 billion. Alphabet also is growing. Their liabilities went up to 55 billion, and their total stockholders' equity is now 177 billion. So if we try to run this ratio of liabilities to stockholders' equity for both companies, we're going to get total liabilities and divided by total stockholders' equity. And then we'll compare the two businesses. See, Alphabet was much bigger than Twitter, but if I want to standardize, or I want to see the performance in general, like how big is the liabilities compared to their equity, then just running these ratios is going to be much more helpful. And we can also see how things are looking over time. So you can see here for year one, we divided the total liabilities by stockholders' equity for Twitter, and it turned out to be 0.47. So for every dollar of equity invested in Twitter, there are 47 cents borrowed for the same company. That number grew in year two. You can see it now, it's 49, or 0.49. This means for every dollar of equity, there are 49 cents that were borrowed by the company. Alphabet has a better ratio, so you can see that the total liabilities are much lower compared to the total stockholders' equity. Even though, if we look at the absolute values, Alphabet has much larger liabilities compared to Twitter. But if we compare to the amount of equity, you can see here that for year one, it's only 29% or 0.29. So for every dollar of equity, 29 cents are borrowed by the company. But it grew a little bit in year 2, so it grew slightly in year 2. It's now 0.31, which means that for every dollar of equity, there are 31 cents that are borrowed by the company. So I hope this was helpful. Please read the chapter carefully and make sure that you understand the details of it. I think the book would be a good reference. If you have any question, please reach out to me. At the same time, I really encourage you to start working on your homework and try to stay on top of everything. And don't procrastinate, because procrastination is your biggest enemy.